The consumer discretionary sector on pace for its worst month in more than 2 years, just as several retail stocks get set to report their earnings this week. For more, let's bring in the top-ranked retail analyst on Wall Street, JP Morgan's Matt Boss, with his outlook. Welcome back. It's nice to see you.
Great to be back.
There are a lot of questions now about what the consumer's doing. Do you share concerns that we keep hearing about?
So we put a note out this morning that I think really digs to the heart of it, meaning you've had the worst start to the spring in 30 years, meaning from a weather perspective, you've had store closures, you have the Northeast, you have basically every part of the country except for the Southwest that's been clobbered by unseasonable weather. On top of it, 30% more snow. So if you think about what's happened, it's pressured store traffic and it's pressured seasonal sales. You're lapping up against actually the warmest in 120 years a year ago. So it's just a very unfavorable. In fact, what I think is really interesting is we looked at that Southwest. So states like California, where the weather has been normal, you've seen zero change in consumer spending. In fact, in the month of February, consumer spending in states like California, Arizona, and Nevada up 5%. That's exactly the same as what we saw in November and December. And we know holiday was solid for the consumer.
Okay, so I was going to say, well, what about eggflation? And what I hear you telling me is nothing is an issue but weather for the most part, in terms of trend-setting things that are going on.
Yeah, I mean, Scott, you and I have talked about this. What we've said, and I don't think anything's changed, is the selective recession that I think is happening. So what's really driving consumer spending is the 50% of the economy that's driven by the higher income consumer. $60 trillion of wealth creation since 2019 is the number. Now, at the low end, they continue to be pressured. But at retail, that means those that are offering value continue to win. That would be your Walmarts. That would be companies that cater to value and convenience, and that's off-price retail. TJ Maxx, which reports this week.
But you didn't hear anything from Walmart and their guidance that spooked you a little bit into that perspective?
Nope. Walmart actually cited that they're seeing a very consistent consumer, but it's a consumer that you need to continue to offer value and also be the most convenient for them. That has been the playbook: value, convenience, and product and innovation that's better than a year ago. Those are the companies that we're seeing win, meaning I look at a Coach brand, a Ralph Lauren. I look at some of these brands that are compounding in the face of what people are calling geopolitical pressures and a tough macro backdrop. If you have product that's better than a year ago, look no further than in the leisure space. Cruise lines are booked out 2.5 years right now, and the pricing is at all-time highs. So if you are offering product that's better than a year ago and you're viewed as a value, meaning you're battling on relative value, not price, that's the equation where you're seeing a real winners versus losers backdrop.
It's interesting that you bring up the cruise lines, which the businesses may be doing great. The lines may be, booking lines may be long. Those stocks got smoked last week on a comment from the Commerce Secretary about the companies not paying their taxes. We're talking double-digit percentage declines in a single day. Environment versus stock prices can be two entirely different things.
No, you're absolutely right. What we do is we focus on the fundamentals, and that's even with today's piece that we put out. The real analysis was, sure, the retail trends that you saw in January, and I think what you're seeing in aggregate in February, are disappointing. It's showing a moderating trend post-holiday, and it's feeding directly into the fears of the larger picture market. But when you dig another leg underlying, the trends, in my opinion, are unchanged, and the consumer remains resilient. That was the message that you've heard from companies so far. That's what I think you're going to hear from TJX this week, and it presents opportunities underlying some of this weakness.
Is that your favorite name of anything? If you had to pick one, would it be that? Would it be Ralph?
So I would say if you're looking for core compounding, market share consistency, look, TJ Maxx just continues to offer that value convenience combination. If you want to step out on the risk curve and think about brands that have changed the way that they go to business, that's where a Tapestry with the Coach brand, a Ralph Lauren, a Birkenstock, and Amer Sports with the Arc'teryx growth brand. That's where I would broaden it out and look at best-in-class brands or companies offering value and convenience.